What's up YouTube? Welcome to Wise Wealth, where we dive into all things personal finance. In this video, we will be focusing on the macroeconomic environment, specifically on the US presidency and what effect that may have on the stock market. Joe Biden was announced president-elect after winning a majority in the Electoral College. It was only last week, in fact, that his victory was confirmed by the Electoral College, and to this day, President Trump is yet to concede. He claims the election was won through illegitimate methods, citing fraud and hidden counts from mail-in voting, but we're not going to focus on that during this video, and more on the policies of Joe Biden and how these could affect shares in our portfolios, ranging from US equities to UK and European, as well as emerging markets. Before we get into this video, if you're enjoying the content, make sure to subscribe to my channel so you don't miss out on any upcoming videos. And if you could hit the like button below, that would be very much appreciated. Thanks for tuning into Wise Wealth, and without further ado, let's get into the video. First, let's start by exploring how the stock market has fared throughout previous presidential terms. As investors, you'll be pleased to know that despite who has been in office, the market has always gone up. So in essence, whether you're an active or passive investor, your investments are likely to do well over the long term. From the graph, you can see that some presidents inherited great situations and saw sustained economic growth throughout their term. Eisenhower is a good example of that. The post-war economic boom of the Second World War saw massive growth during his time in office. George Bush Jr., on the other hand, was not so lucky. He inherited the aftermath of the dot-com bubble, which was later seen to be a decade lost to equities. For example, if you would put your money into an index tracking fund before the burst, you would have only broke even a decade later, which is astonishing in the equity markets. This was compounded by the fact that not only did Bush have to deal with a single economic crisis in the early years of his term, but he also oversaw the great financial crisis of 2008. Whether the administration could have prevented that from happening through regulation changes is still debated to this day and can be a video all in itself, but the fact of the matter is sometimes the person in charge can have little effect on the performance of stocks. So is Joe Biden going to be any different? To dive into this further, let's take a look at some of the President-elect Biden's policies. Joe Biden is a fervent believer in open trade, global dialogue across unions, and across other countries in the world. Biden could look to strengthen relations with bodies such as the World Trade Organization and the European Union. If he succeeds in passing regulatory changes, we could see the reduction in trade tariffs, making imported products cheaper for consumers and increasing margins for the international corporations. Those of us who invest in the FTSE 100, for example, could see operating profits of those companies rise, while US competitors who focus on homegrown production and labor lose out on market share. While the FTSE 100 may be listed on the London Stock Exchange, the international diversity of the companies that represent it is so vast that it tends to fluctuate in weird ways, such that large changes in US market share can have quite a large impact on the UK listed companies. ESG investing and the emphasis on climate change. ESG stands for environment, social, and corporate governance. These are three pillars in measuring sustainability and societal impact of an investment in a company or business. The rise in ESG investing has been a trend that has accelerated throughout 2020 and looks to continue. According to Barclays, 2018 to 2020 saw over $100 billion flow into specialist ESG funds globally, with promising growth year on year. But what drives this growth? There are four key elements for this. Improving coverage of ESG scoring across companies, growing number of environmental projects that need funding, investors viewing ESG as a source of alpha, commonly known as the highest rate of return available, and number four, regulators. This final point is key and where Joe Biden comes in. He is a firm believer in addressing climate change and the need to tackle this issue today, so that the generations to come have a safer future. With Biden in office, regulation will have a growing influence on the market. Voluntary guidelines currently are increasingly likely to become mandatory. We don't need to look any further than his recent comments in the presidential debate on wanting to transition out of oil. What does this mean for oil markets? Those high-yielding dividend stocks that many investors rely on for passive income. Moreover, the transition into electric vehicles and the demand for the commodity. So many questions remain unanswered on this, but there is no doubt that sustainability will have a growing impact on our investment portfolios in 2021 and beyond. The acceleration of ESG investing will not only affect US funds and companies, but also emerging markets. Factoring in both this and the expected road to recovery in 2021, emerging market equities could be poised for a strong bull run where we may see big potential returns in this space. The stimulus bill recently announced, totaling $900 billion, the second largest economic stimulus bill ever in US history, could further drive down the value of the dollar, which also ultimately benefits emerging markets. This could be a further indicator of a potential upside in EM equities. But what changes could Biden impact closer to home? Let's take a look. One of the highlights of Joe Biden's tax plan relates to capital gains, which states that it is asking those making more than $1 million to pay the same rate of investment income as they do on their wages. That indicates close to a 40% capital gains tax on those in that income bracket. A capital gain is when an asset's total sale price is greater than the asset's original cost. The capital gains tax is due when you sell your investment. For example, if your shares appreciate in value, you will not owe capital gains tax during the period that you own it. But once you sell your shares, you must report it as profit on your tax return and pay a tax at your income bracket's capital gains rate. For example, if you buy shares in Johnson & Johnson at $5,000 in January and you sell them for a profit in November at $6,000, you will be liable for capital gains tax on the $1,000 profit you made from holding those shares. Note that Biden's capital gains tax rules only apply to US citizens. I'd be really interested to hear your thoughts on this. Do you think there are other notable effects that Joe Biden could have on the global stock markets? Let me know in the comments below. If you found it useful, smash the like button, I'd really appreciate it. And if you want to see more episodes of stock market investing, then be sure to subscribe to my channel and to hit that bell icon to get notified of new uploads. Thanks for tuning in today. I hope you enjoyed the video. I upload all sorts of videos on this channel, not just this type of content. So if you're interested in investing videos, top fives, and personal finance in general, check out my channel for more. And until next time, see ya.